For decades, the math of buying a house relied on one specific comfort: predictability. You secure a 30-year fixed-rate mortgage and lock in your primary living costs for decades, largely insulated from inflation. Historically, any homeowner association or condo fees attached to the property were viewed as secondary details, minor line items to keep the grass cut, the pool cleaned, and the shared hallways painted. This chart shows the share of new construction built within homeowners associations. Historically, that number hovered around 50%, but today, nearly 68% of all newly built homes are tied to an HOA. Overall market share for these properties has climbed to over 43% of all homes for sale. At the same time, the monthly dues to live in them are climbing sharply. Since 2019, median monthly HOA fees have increased from $108 to $135, while condo fees have jumped from $325 to $420 a month. These escalating dues have created the shadow mortgage. It is a mandatory, uncapped monthly bill that fluctuates aggressively and in many communities is beginning to rival the actual principal loan payment of the home. The fundamental promise of locking in your living costs is gone. Today, the financial stability of your household is directly tethered to the economic volatility of the neighborhood you buy into. The pressure driving these costs upward is structural. Homeowner associations are absorbing massive increases in property insurance premiums, paying higher labor rates for routine maintenance, and dealing with inflated prices for raw materials. But the deepest financial fractures stem from 2021, when the Champlain Towers South condominium in Surfside, Florida, collapsed. That disaster exposed the severe consequences of community boards artificially keeping monthly fees low by indefinitely deferring critical structural maintenance. In the aftermath, state governments, starting with Florida, passed strict safety legislation. Condo boards and HOAs are now required to conduct rigorous, frequent structural inspections of their buildings. Crucially, these new laws carry a harsh financial mandate. Communities are now legally barred from waiving or underfunding their reserve accounts, the communal savings pools meant to pay for major future repairs. Boards can no longer vote to delay expenses to save money today. The legal requirement to fully fund those reserves is forcing a sudden, permanent financial reckoning onto millions of current owners. For decades, many older communities chose to keep their monthly dues low by severely undersaving for the eventual replacement of expensive infrastructure. This created dangerous reserve fund deficits. This diagram illustrates what happens when those underfunded accounts collide with the new safety loss. When an older building is legally forced to undertake multi-million-dollar mandated repairs to its roof, facade, or elevators, the depleted reserve fund is instantly overwhelmed, creating a massive financial deficit. To close that gap, associations use a mechanism called a special assessment. The total deficit is divided up and billed directly to the current homeowners as a mandatory one-time invoice, often reaching tens of thousands of dollars per unit. These are not optional requests. If a homeowner cannot produce the cash to pay a special assessment, the association has the legal authority to place a lien on their property, or even initiate foreclosure proceedings. Buying into an older community today means inheriting the compounding financial liabilities of past owners' delayed maintenance. These mandatory fees act as an immediate barrier to entry for new buyers. The mortgage industry calls this a DTI deal killer. This scale visualizes a buyer's debt-to-income, or DTI ratio. Lenders factor in monthly HOA dues as part of your fixed debt. Every dollar added to that monthly community fee eats directly into your borrowing capacity, sometimes reducing the maximum loan a bank will approve by tens of thousands of dollars. For current owners trying to escape those rising costs, the math is equally punishing. They encounter steep resale friction because potential buyers are wary of taking on such high monthly carrying costs. To remain viable, properties with high dues require steep cuts to the asking price. Sellers are forced to discount the home's value to compensate the next buyer for the monthly dues they must assume. The human toll of this math falls heavily on retirees. People living on fixed incomes are increasingly forced out of their homes, as fee hikes vastly outpace any annual adjustments to pensions or Social Security. In 2026, hunting for a low mortgage interest rate is a distraction. The true cost of home ownership is now dictated by the unyielding volatility of your community's ledger.